Welcome to the Exit Plan Podcast, the show where we dive deep into the stories behind strategic acquisitions, stressful exits, and everything it takes to navigate the world of business transitions. Today, I'm excited to welcome a true dealmaker and visionary. Andre is a founder and CEO of 8M Corporation, a boutique advisory firm that specializes in buy-side M&A and off-market deal sourcing. With over 20 years of experience in the tech and investment space, Andre has advised private equity firms, search funds, and strategic investors around the world. Andre, I guess I have said enough. I would love you to shine light on what you do and what you have accomplished in the last 20 years.
Yeah, absolutely. Thank you for the opportunity. So look, my accent is German. I'm original from Germany, but obviously live here in Austin, Texas. So we relocated a couple of years ago here to Austin, and so the whole story I try it short is so I was a software entrepreneur. After university, I founded two software businesses, all Microsoft businesses. So in the times of Windows SharePoint Services 1.0. So yes, I'm a little bit older. And I sold both businesses in 2008. So I decided operating a business not my thing. So at this time, the business was 45 employees, and some self-reflection here that was too much for me. So I'm not an operator, and I built an M&A boutique in Germany, and yeah, so we did sell side and buy side. Uh, so succession solutions, but only in Germany. And then it was strong growing, and we got a partnership with Translink, that's an international M&A network, and we did cross-border transactions. So we helped US corporates to get a market entry into the German-speaking countries, Germany, Switzerland, Austria. And my wife and I have two daughters. We decided to live the second half of the life here in the States. And we relocated to Austin. And we built an M&A boutique here focused on the buy side. So we don't sell any business because I'm not naive. So no one will give me his business for selling in the US. But the core concept was to help European corporates now to get a market entry here into the States. And that's the reason why I hired a US team here in Austin. And that works pretty well. So currently, I would say 30% of the revenue stream is still from Europe. So I have a client in Sweden, in Italy, and in Germany. And yeah, 70% is now US domestic, private equity, US corporates, searchers, search funds, traditional, self-funded, and some Canadian clients. And yeah, that's the high level story here.
You work with many international clients. For your clients based outside the United States, what does the process of acquiring a business here look like? How do you guide them through the challenges of cross border deals? Could you walk us through how that typically works?
The background story is why we do this. And the why is because we learned that some European corporates, or most of the European corporates, when they want a market entry into the States, what they do is they hire a sales rep. And so sometimes it's a German, and now he's in the US, and they say, hey, look, the product is the same. If you sell this product to the Europeans or Americans, that doesn't matter. But it does matter because the business culture here is totally different. It's all about trust, and you need a brand in the market. And that's the reason why we say, okay, maybe you acquire a business first with a trusted brand in the market, and then you build your portfolio with this brand. And so that's the door opener to acquire. Sorry, to acquire new clients from Europe. So what we do here is, and you know, we only do the off-market parts here, is because we reached out to the brokers in our at the beginning of our journey, and we learned relatively fast that the broker deals here are not really a fit for the European clients, because the decision process in Europe is much more longer. It's sustainable. So because every decision will be discussed at the end of the day, and but the broker deal here, this is a fast market, and it's all about the deal. And you need a fast response, you need a fast IOI, and that is not really possible with European corporates. That's the reason why we say, okay, we reach out to targets directly in behalf of our client.
That's interesting. Tell me some red flags you see during this entire process.
So typically, a red flag for targets is when the owner went away and the sales went away. So it's a strong boundary to the ownership. That's a no-go. So and that's a signal for me. Hey, he is the business. So we can't. So slavery is out of date. So we can't buy him. So we only buy businesses.
Yeah.
And we have to buy the business. And when we buy the business and the owner exit and all the boundaries to the clients or sometimes to the employees went away, and that's a red flag. Another red flag is when you do, of course, that's always a red flag when you do some tax tricks here in the balance sheets or whatever. So
Yeah.
we need clean books and we need a sustainable numbers here. I mean, we don't need or it's not a red flag if you have a constant business. I mean, if you do 200,000 or 2 million EBITDA every year, that's totally fine. So you show, hey, you do a constant a service here, or you have a constant product. That's not a red flag, but it's a red flag when we see ups and down really high. So sometimes EBITDA is negative, and then the next year it's high positive. And surprise, surprise, at the year where we want to buy the business, it's here. So that's a red
Yeah.
flag. So you know the hockey stick.
Could you share a few examples of deals that went south and what went wrong, as well as a few of a few that went exceptionally well? What made the difference in those outcomes?
Yeah, that's a good question. So I would like to step back one step because I think it's not a question about an industry. It's a question about perspective, and it's a question about self-reflection from the buyer here. So I mean, maybe we have to different between someone who will buy the business and operate the business, or is it a buyer that has a financial investment here and the management stays on board? So that's different. I think we are talking about someone who is buying and operating a business. And so I think the questions for the financial is the second step. So because what the first question must be is for myself as a buyer is, can I really operate the business and have I a deep understanding of the industry and the business? So I mean, that's one mistake that mostly the self-funded searcher or whatever did is, hey, you are in the call and you have an entrepreneur on the opposite and he wants to sell the business and he wants to know what is your motivation and what do you know about the industry. If you ask in the first call about the numbers, I think that's a red flag for the seller here. So because he wants to know, okay, who will take over my business? Can he operate the business? I mean, at the end of the day, buying is the easiest part here. So operating is the hard part. Yeah, I mean, I can sign a contract, I can pay money, and then I'm a business owner,
Yeah.
but I'm not an entrepreneur. And and that's what I say to everyone. Hey, first of all, knowledge in the industry. You ask, so I mean, that's a standard question here. So the first material I would like to ask a seller is indeed the last three financials. So I would like to see the real financials. I mean, if you have a brokered deal and there are a lot of adjustments, I don't want to see the adjustments. I want to see the P&L and the balance sheet, the last three. And I would like an org chart. So to get a better understanding how the business is structured. And I would like, I mean, you can do it anonymously. I would like to have the top 10 customers and percentage on the revenue. So that's what I ask for to get an understanding of the business.
What you just said really resonates with me. When I help young doctors look for a practice to buy, I always focus on the financials from the past 3 years. But more importantly, I look at who is actually driving the business. Is it the retiring doctor whose personal relationships and reputation brings the revenue, or is it the team and staff behind the scenes, or in the case of a franchise, is it the strength of the brand itself? In your experience, which industry are most vulnerable to this kind of risk? where the business fails to sustain itself once the original owner steps away.
I don't know if it's really the question about the financials here. I mean, financials are the booking data, huh? So
Yeah.
at the end of the day. So but when it comes for the transition phase and what you explained, so sometimes it's really hard, and it's hard. You have to be a motivated seller after closing the deal that he will hand over the businesses. So what I suggest is before closing a deal. Let's do a transition plan together with the owner and structure the transition plan in modules. So say, okay, look, we have 6 months. You agree to 6 months. So module one is the first month is, hey, I will be included in the business here. So you operate the business and I only review. So the second month maybe is I would like to understand the sales process. The third month is I would like to understand the operating business or whatever. So structure it in modules. And when the fifth month is over, you should be able to run the business because you only have 4 weeks until he left the business. Yeah, what you can do is, I mean, you can secure his motivation in the contract. It depends a little bit on the industry, of course, and on the numbers here. But so if you feel that the seller is not motivated and he's on vacation after closing directly, so I would discuss a kind of an earnout. I know no one likes earnouts, but we
Yeah.
say, hey, look, I need a proof that you work minimum 40 hours until the fifth month, and that's part of the earnout. I don't like earnouts with an EBITDA, so because it opens the door to the court. But the nature of an earnout is I want to secure a running business after closing, and that's the case here.
Absolutely. A lot of first time buyers don't realize they're making the mistake. They come in trying to improve things, but sometimes they end up disrupting what was already
Yeah. So
working.
so first of all, when it is a German or an Austrian investor or whatever. So we are mostly in the precision manufacturing industry. We are mostly in automotive parts or whatever. So it must be a complementary product or a complementary strategy that they have. So because what they don't want is a startup here. So they want an established business and in most of the cases, they know already the business. So it's a community. I mean, if you are an automotive part manufacturer, you should know the competitors in the world, and you should know the supplier industry here. And mostly, it's so what they buy is part of the supply chain here. So that's the most thing. And they know that they are competing against the US American private equities. Absolutely. And that's hard, to be honest, for the Europeans because the values and the pricing in Europe is not so high as in the States here because that's still the biggest business playground in the world.
Yeah.
So they look mostly for a really strategic fit, and they offer more rolled over equity. So to achieve this.
I'd love to get your perspective on a hypothetical scenario. Let's say a buyer comes across a trailer repair business, a classic mom and pop operation that's been around for 40 years. The owners are ready to retire, and on paper, the financials look solid. From the buyer side, could you walk us through the step by step process, starting from reaching out to the broker all the way to closing the deal? What does that journey typically look like, including the key elements of
Okay,
due
so
diligence?
that's a complete process. Huh? So I mean, so first of all, I prefer, and that's another difference between Americans and Europeans. So when you sign an LOI in Germany, I would say the closing chance is 80-90%. So here in the United States, it's only a milestone, and it's a 50-50 chance here. So I prefer. So back to your question, I prefer an LOI that has already the negotiated parameters. So I don't like renegotiating after due diligence or in due diligence. So sit together on a table, at a table with a seller and say, hey, look, we discuss the parameters of the LOI, like these parameters will be placed in an SPA or APA at the end of the day. So that's the first thing I advise. So I know that's hard. The second thing is in the due diligence, try to get in contact with employees. Try to interview some employees. Get into the business in person. So don't buy a business without a visit on site. See if the site is clean, if it's structured, or if it's trashy or whatever, and yeah, and make a plan with the owner and a really honest plan that is realistic to hand over the business. Make a communication strategy with the employees, who says what and when. So, and I mean, if he's old enough and everyone knows that he will be retiring, maybe that's not a tough job here. But at the end of the day, it's a sale, and every transaction scared employees because they don't know what happens next. Is the new owner the same like the old one? Can I stay? If it is a financial investor, will they cut my job or whatever? So really do a communication strategy. So a short anecdote here. So I sold a business, and at the first day, the new owner stepped in. It was an IT business, and the owner, so the buyer was never in the office here of the software business. And he introduced the team. So it was a 30 member development team back in the time. And he introduced the team with the new manager, and the new manager was his daughter. And that scared so many developers because she was a marketing manager at KPMG and not and had nothing to do with IT or whatever. I don't know what the heck he thought about it, but yeah. So at the end of the day, 10 developers terminated the contract 2 days after this introduction.
Oh.
So that's a bad thing. So do a communication strategy here.
You are absolutely right. And to everyone listening, this is something you need to take seriously. If you don't know how to run a business, you should not be
Learning, and
buying
it is
one.
expensive
Take
learning, to
notes.
be honest.
This is
So get an
crucial.
advisor. So I mean, advisor is expensive. I know I'm an advisor. So, but if you don't get someone with experience in the business, you have to learn it the hard way. So you pay for an advice, you pay for experience, and that's worth the money. Honest. So I know a couple of buyer. So they do the financial due diligence for their own or whatever, or they think, hey, I can make the tax due diligence because I'm in CPA. Don't do it. So that has some liability reasons for sure, and get someone with experience in the industry. Maybe he has a different view on the financials here.
Awesome.
Yeah, so a lot of deals did not went well. So I mean, I have to split the anecdotes between, hey, this is the buying process. There are a lot of deals that did not went through, and after closing. So in the process, so a couple of months ago, so that is in my mind, we had a deal that did not close. So the due diligence was perfect. Everything was green, and it was a 10, 11 million transaction. So and at the end of the day, so the SPA was drafted, and the lawyer said, just a formal thing. I have to do a background check. And then he did a criminal background check at the owner, and there popped something up. So I mean, the trust was gone. So to be honest, so because why didn't you talk about your criminal background here? And it was not a drive under influence or whatever. So it was a little bit more. And yeah, that did not close the deal because the seller, so the buyer stayed away. So one of my clients stayed away and say, hey, look, we can't trust you. So because that's a hard fact that we have to know before we close the deal. So it's not really dead, the deal. So they wait until the management went out and they hire a new management. But that was a bad thing. So at the end of the day, everything was fine. Beside this, so trust is a huge thing. Then we had some. It was a broker deal, and so the financials in the due diligence in the data room were completely different, like in the sim. So I mean, there's a couple of stories about this that does not went well. For the closing, yeah, look, I know a lot of buyers with private equity background or whatever. And I mean, these guys are really smart. Huh? So they were at KKR or at Alpine Investors or whatever. And now they are motivated and want to buy a business. And one of these guys was so motivated and he bought a business. I think it was an HVAC business. But then he learned really hard that he has to know how HVAC is working. So how can I repair an AC or whatever? So because the owner, so he was the guy, he was in the roof and repairing the AC, and now the owner stepped out of the business, and there was an open position, so it said, and so you can be smart, but you need to know you have to operate the business and you have to do it.
I really enjoyed this conversation. It's it's offered such an in-depth look at the M&A landscape, especially with your expertise in helping foreign investors enter the US market, where we've covered key processes, common red flags, and what to watch out for before making a purchase. Given how rapidly this space has grown in recent years, what advice would you give to first time buyers? I've had friends from Harvard mention that the focus is shifting, where instead of teaching people how to start a business, they're now encouraging them to buy existing ones and scaling them. What should those new to
Yeah,
acquisitions keep in mind
that's a good question, and
as
I hear
they
this
enter
pretty
this
open. So
world?
Harvard is a pretty good university when it comes to the ETA space. I mean, you know the laundromat case a couple of decades ago, and so look. Um, I said it's half of the truth. So yes, buying a business is easier. So because you think it's easier, because it's running and it's cash flow steady. But my experience is when you take over the business and you don't have experience in operating or owning a business or be a leader in a business, the cash flow drops extremely fast. So when you take over and you have to handle this. So I think the best way, the premium way is, hey, do yourself a favor, found a business, a small business, and operate it. 1, 2, 3 years and try to grow it from scratch because you learn a lot. So you learn how you hire people from scratch. You learn all the tech stuff. That's a bad thing, but it is like it is. And you learn your financials. You learn how sales works and how your product and services can be improved. And I think that's a learning that you need. So again, buying a business is easy when it runs. So, but operating is the hard part. So, and the second advice I would like to give, if you don't want to found a business, you buy a business. So first of all, you have to find the right business. So sometimes no deal is really a better deal. So if you, so I know these guys, they are motivated and they say, hey, I have investors in my bag, or the SBA has approved me, and now I want to buy a business, but it's hard to find a business that matches the criteria and that matches your passion. And that's the second thing. So don't buy a business because it's a cash flow growing business and a cash flow you must be a passion. I make an example. I have currently a client here, and he is owner of a pest control business. And he said, "Hey, Andre, look, I would like to get into the aquarium space." That's new for me, so I've never heard that. But he has a passion for aquariums, so salt water and all the pumps and the fish nutrition. And he said, "I would like to buy a business within this space." He has a passion, and when you have a passion, That will be great. So because that opens doors to targets, and you can run the business because you have a passion. If you think, okay, everyone is buying HVAC because HVAC is recurring revenue, and everyone needs HVAC, or the new hot thing is funerals. So I have so many searchers asking for funeral service and said, hey, that's really depressive. If you buy a funeral business, you have to deal with the death every day. So really, so yeah, but my advice is really find a passion and then buy a business within the passion, or found a business first and learn how to operate a business.
Before we wrap up, I have one final question. For young and first time buyers, could you break down their ideal dream team and what it should look like? For example, there might be a need of an M&A advisor like yourself, some legal support to structure the deal, accounting professionals for financial due diligence, and possibly an operator if they don't plan to run the business themselves. From your perspective, who are the key players a buyer should have around to increase their chances of success after the acquisition or during the acquisition?
That's a good question. So I call it the army of transaction. So you need your transaction army. So first of all, you need a good advisor that stops you. So you don't need an advisor that say, yeah, that's a perfect fit, buy it because I get a success fee. So that's the first filter criteria. And if you trust him and he is really honest with you, he can save your life and your financials. So that's a buy side advisor. And I mean advisor. I don't mean a lead generation guy or whatever. So you need someone that has an understanding of the complete M&A process, that has an understanding of valuation in business, and that has a realistic view of the market here. So that's the first guy. The second guy is your CPA, that you trust him, and because he has to view the data room, the financials, and he has to save you from some risk in the financial in the tax area here for yourself when you buy a business. Then, if you don't have enough funds in place and you use an SBA loan, you need an SBA lender that you can trust, and do a casting of 3 or 4 SBA lenders. And if you think, hey, there are two, they are responsive, so they say what I wanted to know relatively fast. That's a good one. Then you need a legal advisor. So he can advise you if an asset deal is better, if a share deal is better. He can structure the transaction documents, and he saves your ass at the end of the day with all
Yeah.
the warranties he negotiate into the contract. So that's the one. And so I think you need an financial advisor. So if you have a private equity background, yes, I know you know the financials, but sometimes a second view of the data is better. So get a financial advisor on board. And then, to be honest, you need the last guy, and that is a business advisor that is at your side when you take over the business. He must be advise you in sales, in structuring, in processes, or whatever. It's a coach after taking over. So that's the perfect army.
Thank you very much for your time, Andre. This episode has been incredibly insightful, and I truly appreciate you sharing your knowledge and experience in the M&A space. I'm definitely looking forward to a part two. Next time with Valentino joining us, as I know he'll have plenty of great questions for you as well. For everyone listening, if you're looking to buy a business, Andre is absolutely the person to speak to. He's been a trusted partner and invaluable resource on the buy side. Thanks again for being here.
Yeah, thank you, Emmanuel. So yeah, I'm here. So shoot me an email or whatever. So connect with me on LinkedIn. I'm always open to answer questions for free, of course. So no worries. Thank you. Have a good weekend.